In brief exercise 6-5, we're going to put together a contribution margin income statement. So I'll do this in good form. So first of all, we want to put the title on it. So we're going to do Murrigan Ltd. And we're just going to call this a contribution margin income statement. And then it's for the year ended. And I don't know when the year ended is, so I'll just make it up. I'll just pretend it's December 31st, 2022. So the title is the same as a multiple step income statement, which is the traditional one that you're used to. So instead of going sales minus cost of goods sold equals gross profit minus operating expenses to get net income, which is the traditional approach, we're going to separate our costs between variable and fixed. So I'm going to start with my sales. So I'll set the template up right now. Then I'm going to subtract out my variable costs, or I'll call them expenses. Then we'll come up with our contribution margin. Then we'll subtract out our fixed expenses and come up with our net income. So you can call it net operating income. You could also call it profit. You could call it earnings before tax. Then I actually want to show two columns here. So one is the total dollar amount, and then the one is the dollar amount just for one unit. And I also need to, I'll just put it up here, just volume, and I'll just highlight this in yellow. I also need to know how many units were sold to make the 45,000. So I'm just going to pretend that we are selling cookies because it doesn't say here what we're actually selling. So my default is just, I'm assuming I'm making and selling cookies. So when I look at this 45,000, that's the number that goes here. And it tells me that the average selling price for the unit sold was $15 per unit. So I'll put the 15 right here. And since it's 45,000, if I put 45,000 right here, then I know if I take 45,000, divide that by 15, that gives me 3,000 cookies. So this income statement is based off of me selling 3,000 cookies. And I'll do the math over again. So just to make sure that I did it properly, now I can just go $15 per cookie times 3,000. That's how many you sold. You have 45,000. Now we're looking at our variable costs. So this could be your variable manufacturing costs, just like your direct materials and your direct labor. It could be variable manufacturing overhead, and it could also be variable selling and admin costs. So now we don't really care between product and period costs. We care between variable and fixed. So variable just means that this unit amount stays the same, but the total amount will change because it'll go up and down based off of how many cookies you make. So if it tells me that the average cost for a cookie is $9, then what you can do is take 9 times 3,000, and then that gives me 27,000. In order to get contribution margin, what we do is we take 45,000 and we subtract 27,000. And then that'll give us a contribution margin of 18. So that's just basically your profit before paying your fixed expenses. And if I take 15 and I subtract 9, then that's my profit per cookie before fixed expenses. So I like to end this column right now. I don't like to look at my fixed expenses on a per unit basis. So I'll just leave this at 6. Now I need to go find my fixed expenses, and I think the best way to do it is they don't tell me down here what the fixed expenses are, but I do know that this total cost was 39 and I already allocated 27 as variable, so by default the remainder has to be fixed. So they can only be variable or fixed. Those are our only two choices. So if I take my 39,000 minus my 27,000, then I get 12,000 for fixed costs. And remember, these fixed costs stay the same regardless if I sell 3,000 cookies or one cookie. You're always going to have to pay the 12,000. So now I'm going to get my net income or my net operating income. So I can take 18,000 minus 12, and then that'll give me 600. So it's the same operating income. So I'm going to show you now why I even did this in the first place. Remember when I said that the variable costs and the selling total costs are based off of volume? Look what happens if I play some what if. Like, what if I sold 10,000 cookies instead of 3? If I type in 10 here, then you'll notice my sales and my variable costs changed. So my sales went up and my variable costs went up. So my contribution margin went up. But the fixed expenses just stayed at 12. So I have a net income of 48. Let's try and go lower. Let's see what happens if we sell 1,000 cookies. So I'm going to type in 1,000. Keep an eye on those fixed expenses because they're still going to stay at 12. All of a sudden, if we only sell 1,000 cookies, then we lose 6,000 because we don't have enough contribution margin to pay our fixed expenses. So the problem is that our fixed expenses don't change. So it's based off of whether you sell 1 cookie or 10,000 cookies. Now, what I really want to see is a baseline. So what would it look like if my net income was 0? So that's called break even. So break even is how many cookies do I have to sell before I even start making any profit? So you can just guess in here. Let me guess 2,500 just for fun. My guess is too high because I still have income of 3. Let me guess 2,000 just for fun. Oh, that guess was right because now my net income is 0. So you'll see that's at the point where your contribution margin is the same as your fixed costs. So I have to sell 2,000 cookies in order to make nothing. A quick way to do that instead of guessing this number, so I'll just say break even, is taking your fixed expenses and then just dividing that by your contribution margin per unit. So if I take my fixed expenses of 12,000 and I divide that by my contribution margin per unit, which is 6, then that is going to give me 2,000. So that's the volume. So that's a really quick way to calculate the volume without having to guess going up and down and then trying to see if my net income zeroes out. But I'm going to put this back to, I believe it was the 3,000. So that's what this income statement was based off of. And we are done.